Guess what time it is? Just kidding. Keep going.
Dude, I'm telling you right now, like I get my family.
That wasn't
from,
meant
like,
to be
Midwest.
racist. Sorry.
Did you just call me a turkey butt? Who you calling a turkey butt?
I'm calling somebody a turkey butt.
Mobile phone have a really big family. They got like 20,000 over like 50 different in-laws.
If you guys are liking all the information you're getting from us, if you're feeling that we're educating you, please smash that like button, subscribe, DM us with any thoughts or ideas for our show, and also tell your friends and family about it. Share us on social if you can. Would love it. Welcome to the Mortgage 101 podcast with Anthony and Manley.
You're listening to the Mortgage 101 podcast, hosted by Anthony and Manley. Gen Z is ready, rates are easing, and home prices are resetting.
You ever heard someone say, now's not the right time to buy a home? Well, today we're calling that out because Gen Z is quietly stacking cash, home prices are resetting, and the mortgage rates just gave us a window.
Yep, and if you're waiting for the market to be perfect, you might just be waiting forever. Today's episode breaks down why strategy beats timing and why readiness wins every time. Let's jump right in.
This week, we're stacking some serious truth. Gen Z is saving smarter than any generation before. Home prices are cooling for the first time in years, and rates just took a skinny dip. So whether you're 23, 63, or 43, this market is giving you a shot. Let's break it down.
Yeah, I mean, so let's talk about how, Gen Z is quietly getting ready for the mortgages. They're getting all their ducks in a row, and we're seeing them ask all the right questions, prepare all the right things. I mean, here's a stat that may shock you, Manley. 5% of Gen Z is saving all of their income, every single dollar. You're thinking they're way too young to buy a house. Nope, they're just saving. They're investing early, automating smart moves, thinking long-term in a way that's rare today. So if you're a realtor or a lender or in the mortgage or real estate, sphere, wake up. These buyers are coming and they're more ready than you think. Kudos to the Gen Zs out there. I mean, let's do a deep dive, Manley. I worked with a 23-year-old recently who had an automated savings through Digit and invested through Acorn. Already knew how to pull her credit report. She didn't even need me to explain what a debt to income ratio was. She had a spreadsheet. It was absolutely unbelievable, and she was 100% prepared.
Hey, same here. I just had the same situation. Had a client, 24, who had been budgeting for 2 years, came in with a 720 credit score, $18K in the bank, never rented, lived with family, and saved everything. That's a mindset. That's not accidental. That's coached.
Yeah, that's definitely not accidental, dude. And hey, that's our job, not to wait until look ready, but to help make them ready. The difference between being reactive and proactive, that's the entire game, right? It's being ahead of the curve, not being behind the curve. And so these Gen Zs, I have a feeling that they were the quiet horse. They were the dark horse. We were just thinking these guys are clueless when in fact they were clued in. And so it's a breath of fresh air, at least for me.
Absolutely. You want to win in 2025 and beyond? Start mentoring your pipeline. Share content. Host some workshops. We're building futures. All right, you guys. We're moving on to the next segment. Home prices are cooling, you guys. Hey, home price growth just slowed to 2.7%. That's the softest pace we've seen in nearly 2 years. You're thinking, yeah, but prices are still too high. Compared to 2021 and 2022, of course. But now the inventory is up. Bidding wars are down. Sellers are adjusting, and that means leverage is back. This is the moment thoughtful buyers have been waiting for. If you're strategic, you can structure a deal, negotiate credits, and lock into a home with power. Case in point, I recently helped a family buy in a hot Milwaukee zip code. They offered under asking, added an inspection contingency, and got a $12,000 towards closing costs. A year ago, that was impossible.
Yeah, I mean, talk to me about that. That $12,000 in closing costs. I mean, that's not something that if it was a seller's market, we can get all the time, right, Manley?
No. Just like I said, a year ago, not happening. 6 months ago, not happening. But we're getting them now. We're getting seller credits for closing costs.
I'm seeing sellers give credits for pay for repairs. buy down points, for the rates. That's huge. It's a huge reversal.
Yeah.
Yeah. From what you're saying, I hear is the market's not crashing, it's normalizing. It's like the housing market exhaled and took a deep breath. Buyers can finally slow down, compare homes, look at different programs, whether it's VA, FHA, DPA. When buyers stop racing, they start winning and they start making the correct moves, right?
We're using the FHA, the VA, the DPA. When buyers stop racing, they start winning, just like Anthony just said. Yeah, we'll tell people, don't wait for the perfect market. It doesn't exist. Balance. We got to find the balance. And guess what? The balance is here. Use it.
Yeah. And speaking of balance, man, let's talk about how, these mortgage rates are starting to ease up, right? I mean, we've been talking about it this year and we're living it now. We're seeing it. I mean, I think the biggest takeaway for our, listeners today is just know that, just think about the premise right now. We are not talking about rates going up. No one is talking about rates going up. They're only talking about rates staying steady or going down. That is a big flag to go, hey, if you're on the sidelines, if you want to be reactive, go ahead and still stay on the sidelines. But if you want to be proactive, we are talking about nothing but rate decreases. If you wait until you start seeing the rates, you are going to look to your left, look to your right and go, oh my gosh, this party is crowded. I wonder if I'm going to get the same things. I mean, today's rate sheets, it's the best we've seen in weeks. That window is briefly open. I mean, you may think, I'll wait a few more weeks or a few more months to see if the rates drop more. And by the time the headlines say rates are dropping, you've already missed that dip. You've already missed the boat. Most are prepared. Buyers don't chase rates. They chase themselves to act when the moment shows up. We're telling you right now, the moment is showing up. Case in point, let's do a deep dive, Manley.
Let's break it down. The 10-year Treasury yield dipped to 4.22. We've been looking for that window. When yields drop, MBS prices strengthen, and lenders improve their rate sheets. Mortgage-backed securities, that's what I'm talking about. That's what drives our actual rates. We saw that exactly happen. The markets loved Powell's cautious tone at the ECB forum. No major rate cuts yet, but no surprises either. That steadiness gave mortgage bonds room to breathe that we have not had. That's why we're feeling it as we are, Anthony, that we're not worried about rates popping up like we were a month ago, where we were going to see a 6.875 go to a 7.5 rate, like in a day and a half. We saw those swings. They were wild, but I don't think we're there right now.
Yeah, I agree 100%. It gives us time to breathe.
Yep. That's where I was seeing a lot of stuff happening at 7.2, 7.125, 7.275, depending on, what your income was, what your credit score was, all the components. But that was in that middle of that road. It was above 7.
Yeah, I mean, listen, that's tens of thousands in savings. You can't win by hoping. You win by preparing. Pre-approval in hand, docs ready, loan structure dialed in. The best rates go with the most who's ready, not the most patient, right? You can't time the market. You have to jump in the market and prepare. That just gives us an understanding of where we're headed to, which kind of brings us into, our next segment, Mortgage 101 Rate Prediction Tracker.
January to July 2025. We're talking about what we were talking about back in January and what we think the end of the year is going to look like as an average. So, all right, here's the Mortgage 101 Rate Tracker update. Let's rewind to January 2025 when we set the forecast for this year. We called for the forecast range of 5.8 to 6.5%, meaning that we're going to see a forecast average at year end at 6.15%. That's what we were predicting.
Yeah, and now we've got 7 full months of data. I mean, here's how it's played from month 1 in January to year to date, and what the trend really tells us. January, we saw 6.65%. February ticked up a tad to 6.73. March, we saw it, up to 6.84. We're going in the wrong direction, but then we started seeing what we were anticipating. April, we saw a dip down to 6.74. May, we saw a dip down to 6.68. June, we saw another dip to 6.64. Now, July, we saw a little tip up to 6.71, very small, but I mean, we got to think of why, right? It's all about how far the runway shows. And if there's clouds in the peripheral view and there's uncertainty and there's volatility, we price to the defense. So in my opinion, The fact that we went from a 6.64 in June to a 6.71 in July, such a small amount, but we had so much tumultuous headlines with World War III. I mean, the way I'm seeing it now, I think we're going to definitely hit our mark. Now that I'm seeing, even though we had some craziness over the past 60 days, it really didn't show up and the market didn't materialize. That's a good sign for what's to come towards the end of this year, right?
Yeah, the year-to-date average actual rate is sitting around 6.709. So yes, it's above our original prediction rate of 6.15%, but we still have an entire half a year to go to get us there. So we're on that pace, Anthony. I'm with you. Again, we're saying the same thing. I love it. No big deal. We're there. I truly believe that we might see an average rate getting closer to 6 because I feel like we're going to have a little rate dip. I think that the Feds, when they do move the rates, we're going to have a little positive influence to mortgage rates as well, even though they're not the same. I feel like we're going to have a little positive influence on that as well. So I'm hopeful we're going to see that closer to 6 and 6.15.
I agree. And here's the nuance. After peaking in March, rates eased for 3 straight months, as we just saw, before slightly ticking back up in July. With the volatility in the geopolitical world and the pending wars and the tariff debacle and all that now seem to be behind us. We have more runway. We have less volatility, which is what we want to see in the market. So I think we're on track. I think we're very much on track for what you and I first anticipated month 1 of 2025.
Final take right now, we're on track. Slightly overestimated the drop, but it's not a mistake. It's a reality check. The momentum is still trending towards stabilization. So to recap, we're going to see the following. The Mortgage 101 forecasted range, 5.8 to 6.5 forecast average of 6.15 year end. The trend line, slight downward pressure since mid-June, but we're getting there.
Hopefully you like all the education that you're getting from Manley and I. Do us a favor and smash that like button, subscribe and follow, and tell all your friends and family about us.
Guess what time it is?
Oh, yeah.
The rapid fire buzzwords with our producer, James Zahorik.
All right, guys. So I got some words here for you. We're just going to go through it. So first one that I have up is Gen Z. Take it away, Manley.
The Gen Z. I had to look it up just to make sure I was right because there's a lot of generations, right? That's the age 13 to 28 years old. There's a bunch of 13-year-olds that aren't buying any homes or doing any of that stuff right now. But back to that, they're the ones that are getting smart in their savings, and they might have more savings account than I do right now. Who the heck knows? They're the digital age. They're deeply connected to social media. They're just wired in. This hasn't happened in generations. The amount of savings that they're doing, the consistency, the tunnel vision that they have right now. So that's my quick take.
Yeah, Gen Z. I mean, that's the generation of technology. 100%. They saw likes of transformation that we have not seen since Industrial Revolution, and we're going to continue to see. If we do not grasp technology and automation and customization and AI like Gen Z is doing, there's going to be such a gap in the understanding and the mindset. So yeah, man, it's exciting times. We just got to embrace the change, and we got to continuously, look at the processes and how they are diversifying based off of this Gen Z's mentality.
All right. Well, thanks for the 2 cents there. Next one I got up here for you is automated saving. Tell me what you're thinking there.
Automated savings is the definition of you live within your means. I'm seeing a lot of Gen Zs come to me and go, hey, I have a lot of mobile saving applications. And I'm like, oh, okay, what is that? And they're like, oh, I have, this app that takes a certain amount of my income and pushes it to here, automated this and automated that. It's kind of like what we do with our 401k and our stocks, but they do it on a more granular level. Here's automated savings for my vacation. Here's automated savings for my fund money. Here's my automated savings for my home purchase. This is what they're doing right now, which is something that we have not done with our generations.
Well, back in the days, they used to put in envelopes that were labeled vacation, new fence for the backyard to keep the dogs in, all those type of things that were happening. And then they put the pile of envelopes in the freezer.
I even had a client do automated savings through crowdsourcing. They have a really big family, and they put a GoFundMe. So that way, it literally said, GoFundMe so I don't have to live with my mama. And they got like 20,000 over like 50 different in-laws. And then when I
my
ask
gosh.
where their money's coming from, they're like, here's a statement from the crowdfunding. And I'm like, I sent it to my underwriter and they go, we can use it. It's sourceable. I'm like, that's amazing.
I've had to do a few of those transactions though, and they're usually people from the Middle East that got like 10 family members that are all pitching in $5,000, and I got to do 10 gift letters, and it's all coming from overseas. Not a lot of fun. Been there. I had one that we were going up to 17 gifts, and I'm like, you guys, I'm done.
Next one here is tell me more about buyer leverage and what that means.
But buyer leverage is really the value, where they can put an offer in, and do they have the ability to do a home inspection? 3 years ago, 4 years ago, COVID style, it was wild. No home inspection, no appraisal inspection, maybe no even finance contingency. I mean, I was helping people do these wild cash offers when they had no intentions of doing, paying cash. Now the buyer leverage is back. We have that opportunity to, let's be sensible. Let's ask and make sure we get a really good home inspection and understand what kind of problems we might be getting into or not getting into in this home we're trying to purchase. And then we're not necessarily going to offer over sticker. We might not even offer sticker. We might offer a little below and ask for these things. We want the home inspection. We want the appraisal. We want the financing contingency. And guess what? We're also going to ask for $5,000 in seller closing cost credits to boot, because we want you to help us pay for some of this. And we want to make sure in this new world we're in that you're paying my buyer's realtor fees as well. So that's what's happening. That's buyer's leverage. And we're in that kind of market or entering that kind of market right now.
Yeah. And I would say, just to tap on that too, like buyer's leverage, one thing that is the really most empowering tool is now that buyers have time right now. Before, like in COVID, they didn't have that time, because it was like, if you're not putting an offer and you're not doing highest and best, it's just go, 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 go. Buyers have time now. They are swimming in time, and they have all the resources at their hands. They have all the metrics. They have all the math. And it's like, I'm telling these buyers, like, you have such a great opportunity. Do not let fear dictate your future decision-making. Because if you let fear dictate your future decision-making, you are not living in the now. You are living in a place that is erroneous, that has not happened yet, and is based off of other people's insecurities.
All right, next one I got for you is pre-approval. Tell me your thoughts on that.
Pre-approval is great, right? So I know we talk about this probably every single time, but I think we need to really drive it home. The first thing that our clients have to do, in my opinion, is 100% get pre-approved. Not pre-qualified, where they just kind of do a quick little credit check and kind of give back of the napkin stuff. Do you want someone to go, oh, you're pre-qualified? Or do you want to get someone who's your verification of employment, income, assets, credit? Everything has been verified and certified, and you are ready to go. The one thing that I love about Rate, which myself and Manley are vice presidents of mortgage lending in different regions, but we have what is called a power bid. What does that do? That allows us to not have to wait for us to go into escrow. What is escrow? When we go into contract. And we don't have to wait until we get to that point. We can push everything to the underwriter before our client starts shopping. And we can get everything checked off, because you want to focus on what matters, and that is finding the right house, not being under stress, not being pressured, and more importantly, not having a change at the 11th hour. Buying a house is emotional. And when you walk into that house and you can see your kids playing and you can see your family eating dinner, you're like, I'm now emotionally attached. Then when you look at the payment, you're like, what's this payment look like? Oh my gosh. I never want my client to walk into a house and have a question mark of, can I afford this? That's why and I'm sure I've had plenty of conversations with you, when our clients walk into a house, we've already educated them. We've already made them so confident and in the know. They know their payment. They know they're out of pocket. They know what their max budget is. So when they walk in that house, if they want it, they can get that house, and they have no reservations.
They can negotiate with power. They understand if I'm doing at list price 10,000 over, 10,000 under, what my payment's going to look like. What does that make me feel like? What is this house worth to me? It's all about the education process.
You can interchange pre-approval with confident buyer. Pre-approval, confident buyer, same thing.
That sounds good on the pre-approval. Next one is something I don't know much about. Tell me about Treasury yield.
Well, so mortgage-backed securities are really what drives interest rates. We look at the 10-year Treasury, a looking glass, so to speak, getting your eyes in the scope and looking out in the future. But really what drives it are mortgage-backed securities themselves and the yield itself that comes off of that. So like today, I look at a 5.5 coupon. This is getting deep into the weeds, you guys. The 5.5 coupon is what it trades at. And so what does that mean? So it's trading at 5.5%, and the current yield on that, I think, ended up at like 98.88 or something. Actually, no, 99.84. That's the one that I watch and see the ebbs and flows of that. And that's what doesn't move exactly in lockstep when we are talking about the overnight Fed fund rate, which is everybody talks about. The Feds are going to lower the rate. That's what we're talking about. Two different things. They don't walk line in line parallel with each other. They're loosely held together. They do have a reactionary mode. But again, Treasury yield is the yield off of the mortgage-backed security or the 10-year Treasury note.
At the end of the day, you want a lender that's not just pushing a button, but there is some intelligence behind that, right? We are not just pushing it and blindly going, we're looking ahead at least a day, a week, 2 weeks, saying, when is this close of escrow? Is there any major things that could potentially drop these rates or raise these rates? Now, the caveat there is we don't know who's going to tweet what. We don't know if a world war is going to break out. We don't know if, a jobs report is going to, go erroneous based off of what's predicted. But what we do is there is some nuances, right? There's some nuances that we can look at to go, this makes sense. We can absolutely do that. If we have a 30-day or less close, unless there's something massively that can affect it to the good, I tell them to lock it.
I try to educate my clients, and I don't tell them that I ever have a crystal ball. I have some predictive things that I can look at and things that Anthony's talking about. And we're looking at trends, which are very difficult to read in this world that we've been in the last 6 years. The trends aren't normal. They're not the same. So it is a little dicey, but it is really relative to your closing date and the time that you're trying to lock. 30 days or less. Be careful. Lock them if you got them. Unless you know that there's something coming up, we're getting some big report that's going to have a market move, and then you're at risk. So the beautiful part about the risk guaranteed rate has this wonderful float down option, and if we lock and the market takes a 3/8% move, we'll actually do a one-time float down for you at no cost to you. So that's something that not everybody does. Some people do. Some people have different parameters, but I'm proud of that, and I can tell people with a good conscience that we could lock today, and if we do get this massive move that everybody keeps saying, "Oh, we're going to see the 2% again," we're not going to see that. By the way, we can take a one-time float down to that. So anyway, moving on.
Absolutely.
Sorry about that, James. Again, here we go.
Just let me know what you guys are seeing with contingencies these days.
Right? So there's contingencies on the seller side and there's contingencies on the buyer side. And so typically when you have a purchase agreement, you have a conditional loan contingency, you have an appraisal contingency, and you have a final loan approval contingency and a close of escrow contingency. Depends on which state that you're buying in. But for the most part, it makes sure to protect the buyer. So, for instance, the appraisal contingency. If the appraisal contingency is typically 2 weeks, and then you order the appraisal right out the gate, and if the appraisal comes in under, if the sellers decide not to adjust the sale price to meet the appraised price, then the buyer can step away and they're protected and they don't see any financial ramifications on that other than the cost of the appraisal. But their earnest deposit, everything's protected. The same goes to the initial approval and the final loan approval. Those are to protect the consumer, the buyer, so that if some unforeseen circumstance comes to where they are not approved, they are still not on the hook. They can get away and financially they're sound and they're intact. So contingencies are important. It's important to talk with your realtor to understand these.
Perfectly said. Perfectly said. Good job there, Anthony. We're going to move on here to the next one, James.
All right. One more that we got here is rate lock. Tell me your thoughts on that.
The rate lock is really important, and we talked about it a little bit too, the length of time to close. And rate locks, the longer the rate lock period, the worse the rate is. The shorter the rate lock period is, the better the pricing is on it. So we hopefully lock within 30 days or less, or even a 15-day lock. We're going to get a little better pricing. So we just need to understand where we're at, and you're hopefully going to have a good loan officer that's going to talk you through and explain to you and just say, yeah, at a 45-day lock, because that's when our closing date is, 45 days, probably not your best rate. Let's think about what's happening in the market and where we sit and go from there.
Yeah, and just to add to that, just think of like you have a bandwidth with your rates, right? You have what is called par. And so par is basically, it doesn't cost you anything to lock, meaning you don't have any extra cost or points. This misconception is points go to the lender. It's not the case. It's based off of the market where you're locking at. So if you lock at par, there's no points. Or you can lock below market and you can push down the rate for a cost and you'll see those points. So that's where it's important for your loan officer to look at the break-even rate on that lock. Because what you don't want to do is spend $10,000 to drop your rate 0.5%, saving $100 a month, and you're not going to save that $10,000 for 10 years. And then in 2 years, when the rates are down to the fours and you save $2,400, but it costs you $10,000, now that doesn't make economic sense, and now we're flying blind. So when you lock that rate, you want to make sure that you're locking with confidence and with math and with education. Otherwise, you are locking blindly.
If you guys are liking all the information you're getting from us, if you're feeling that we're educating you, please smash that like button, subscribe, DM us with any thoughts or ideas for our show, and also tell your friends and family about it. Share us on social if you can. Would love it. Well, guess what? We're in the bonus segment, Manley's Don't Be Dumb moment. Hey, I had someone tell me last week, I'm waiting for those rates to hit 4% again before I do anything because rates went down to the twos, so they're going to come back down to the twos again. Okay, cool. Let me know when gas drops back down to $1.25 too. Probably not going to happen. You're waiting for a fantasy, folks. Meanwhile, the folks who are ready and able to build equity are pulling the trigger and making stuff happen.
It's strategy over fantasy, action over assumption. If you are fantasizing over these rates that we're never going to see again, which is 2s and 3s, those rates should have never existed. And that's why we saw that boomerang of rates, inflation go from 2 to 9 because they printed too much money. They had the gas to the pedal when they were doing quantitative easing. They had to reverse set to start quantitative tightening. Is it uncomfortable with rates in the 6s? Yes, but are we going to get back to the 4s and 5s? Absolutely. Is that a normal market and we can breathe and assume? Yes, no problem. But it's a fantasy if you're thinking that rates are gonna get there. You really need to be thinking strategy, like you said, Manley. If people are thinking they're gonna wake up and rates are gonna be 4, yeah, they will. But that's 2+ years of you paying down the principal, of gaining appreciation, of having tax incentives. There was the big bill, to talk about that just passed. It's beautiful for homeowners. They brought back 100% bonus depreciation. What does that mean? Yep. That means that if you're buying real estate and you set yourself up and you strategize, you could potentially write off 100% and completely take yourself out of a whole tax bracket. The current administration is trying like all heck to lower the Fed rate because they know that it'll lower the interest rate. At first, I was like, it ain't going to happen, but I think they're going to try to beat this dead horse until it does. These next 90 days are going to be interesting. The strategy right now is get prepared. If you're not getting prepared and you're just waiting on the sidelines, that's a fantasy. You're a unicorn.
Well, hey, final thoughts. Let's talk about that elephant in the room. Gen Z is prepping. They're not sitting on the sidelines. They're learning, they're saving, they're investing, and they're quietly positioning themselves to buy homes.
Yeah, meanwhile, a lot of older buyers like Gen X, boomers, even some millennials, they're stuck. They're in a catatonic state. They're stuck in that idea that rates are too high, prices are too high, but what they're not seeing is what they already have that Gen Z sees. Gen Z can see this on the table. They're planning for it.
The older buyers, the 401ks, the money markets, the stock accounts, the long-term savings, they have eggs in a basket, but they're not using them. They're holding out. They're paying high rent, waiting for that perfect scenario. I told Anthony about this the other day. I had 2 gentlemen that they're so similar to each other. It was scary. They were different people that were both in their late 50s that have been renters their entire life. I spent a little bit of time with them and showed them what they could do. The one had a really good credit score. The one had a medium credit score, but I was able to get them both into homes, beautiful homes They're both non-renters. They closed last week. I mean, it was a magical day in my career to watch these guys that I just helped them, reallocate some debt, get themselves so that they felt more comfortable with the monthly payment. They both had great income. I mean, I'm telling you what, I got teary-eyed at the closing in both of them. It was wild. I'm like, these people were lifer renters. They just needed to talk to the right person and have them put it in the right light.
Yeah, I mean, here's the truth. You don't need lower rates. You need better strategy. Use what you've built, leverage it wisely, reposition, reinvest, move into something that gives you a better quality of life and more financial freedom. It's about balance, right? I got clients that come to me and their quality of life is so low and they have this massive amount of assets that are just sitting there doing nothing. And then you have the opposite, which people are living way beyond their means, but they're super happy. So it's really a mindset, right? One thinks they're doing the right thing and is completely different than the other, but they both are in a headspace that they're happy. In my opinion, financial freedom and quality of life has to have a balance, right? And so as long as you're working smart and you're leveraging and you're strategizing, you'll find that balance.
Preach, brother, preach. Stop using rates as an excuse. Start using your position to make progress. Get your turkey butt off the sidelines. Stop being a renter by choice and take some action. You've already got the tools. You just need a plan. This opportunity doesn't wait for the perfect time. It shows up for the prepared.
Yeah, I agree with you, man. I think this was a great episode. We really dug deep, especially in the difference in generations and their mindset. And hopefully it's eye-opening. And people have a mindset of continuous process improvement. That's what it's all about, right? Continuous process improvement. Waking up and improving the process so that way when you lay your head at night, you've improved and it's a continuous growth, financially, wealth-wise, emotionally, everything. So like, follow, subscribe, DM us for more information. Yeah.
You have something specific you want us to talk about? Let us know. I mean, we're all ears.
sure.
We're trying to educate you guys, and hopefully we're doing that. And let us know if there's something specific you want. But just please smash that like button, subscribe. I hope this was value.
Mahalo, brother.
Appreciate you much. Have a good one. If this episode helped you feel more confident about your home buying journey, do us a favor. Share it with a friend, subscribe, leave a review, and if you've got a question or a topic you want us to cover, hit us up with a DM or a comment. Thanks for listening to the Mortgage 101 podcast. We'll see you next time.